Mortgage renewals have been a really, really hot topic for a while now, and figuring out the best product, the best lender, the best term, it's challenging at any time, but even more so during a period of economic uncertainty. Rob McLister is the founder of mortgagelogic.news, and he joins us today to talk through an acronym he came up with like 15 years ago to help people, help brokers, help borrowers make some decisions about their mortgage. It is I.D.E.A.S, I.D.E.A.S. He joins us today from Naples, Florida. Hello there, Robert.
Hey, Bruce, good to be with you.
Thank you for joining us. Your focus is largely on brokers, but consumers, because I read your newsletter all the time, consumers, borrowers, homeowners can learn so much from the kind of insight that you bring to the whole conversation. Tell us about this acronym, I.D.E.A.S, and what you were trying to do when you came up with it.
Yeah, so with the number one questions to most mortgage brokers or most bankers is, what's your best rate? The number two question is, should I go fixed or variable? And so that's what IDEAS was born to help people figure out. And so IDEAS stands for income, debt, equity, assets, and sensitivity to risk. And it's basically an acronym that helps people decide which mortgage term is best for them.
You wrote that it is a theoretical formula that calculates the ideal term length and rate type based on borrower input. So let's talk about those inputs, starting off with income. So if you've got a job, it's probably fairly straightforward. You look at your bank account, you see what your after-tax income is. Are there thresholds to this first one? Does income to cost of living factor in as you include as you think about that?
Yeah, so there's no specific algorithm, but in general, the more stable your income, the more risk you can take with your mortgage. So, if your job was vulnerable, for example, that would make you less suited to a variable rate mortgage or a short-term mortgage, other things equal.
Right. So the person who's an educator in the public system, pretty solid job prospects. The person who's an entrepreneur in a volatile sector, income could be a real question mark for a lender.
Yeah, yeah. In
Yeah.
this last rate hike cycle, we saw rates go up such that people's payments were soaring 50+%. And so imagine if you're on an income that varies by maybe because you make a commission or something.
Yeah.
That so you get that stress of surging payments, in addition to not knowing exactly how much money you're going to make this month. So other things equal, folks in that boat generally prefer fixed rates.
D is for debt. How do you factor in unsecured debt? Like, is this the full picture? Student loans, maybe you owe some money to CRA. How do you think about debt?
Yeah, so the more debt you have relative to your income, the less breathing room you have, other things equal. And so, you don't want to get in a situation where rates are surging, your payments going up, you're going to have a short-term mortgage, maybe that's renewing quicker, and you're going to see payment shock there. So, the more debt you have relative to income, generally speaking, the less risk you can take.
Equity is the E. So the question you raise is, does the borrower have enough equity to refinance in an emergency? How much do they need? How do you think about that?
Yeah, so personal finance is largely about liquidity. So, the more equity you have, the more cash options you have if things go bad. And in turn, the more risk you can take with your mortgage term. So, more than 20% equity gives you a heck of a lot more flexibility than someone that just got a CMHC mortgage with 5% down, because they're not going to be hit that 20% mark, which is the minimum equity to refinance for several years.
The A stands for assets. So, does the borrower have liquid fallback assets to ride out financial storms? Is the question you ask. What are some examples on liquid fallback assets?
Yeah, so a lot of people have, GICs, a high yield savings account. Even worst case, if you're going to miss your mortgage payment, obviously you and I both would probably never tell people to tap into their RSP unless it was like a life and death situation. But I mean, you don't want to lose your house either. So any type of assets that can be relatively quickly converted to cash, again, allow you to take more risk with your mortgage term.
The S is sensitivity to risk, which sort of feels like a basket of a bunch of things. What are some questions you should ask yourself to determine your sensitivity to risk?
Yeah, so this is that cliche sleep at night factor, right? Do you have the risk tolerance to trust academic research, which supports floating rates over fixed rates, based on some pretty reputable research? Can you tolerate a 200 to 300 basis point rate spike for 18 to 24 months? Those are the types of questions you need to ask to determine if you're fit, if a variable rate mortgage fits your financial profile.
How do you summarize the academic research on fixed versus variable? Because I'll be interested to hear what you say, because I have a number in my mind that would support variable over fixed. How do you say it?
Well, so Moshe Milevsky is the godfather of fixed versus variable research in Canada, York University professor, one of the smartest guys I know. And he did basically a back test. And he went back several decades and he found that, up to 90% of the time, variable outperforms fixed rates, meaning it costs less to go with a variable. However, that depends on a whole slew of assumptions. And one of the biggest assumptions is what is the discount that you're assuming on that mortgage? Because your probabilities of success in a fixed or variable can change radically depending on the discount you get, where we are in the rate cycle. Like as a good rule of thumb, you look at an 18-month moving average of the policy rate. If we're way above that, as opposed to way below. Way above, generally speaking, historically, variable rates have outperformed. Way below, fixed rates have outperformed because rates are cyclical. So the question is, can you trust that research? Can you trust those historical tendencies? Because things can come out of left field. That it doesn't matter how often variable rates have won in the past. You can't handle that 30-40%
Yeah.
increase.
I think how I would play that back, and that's consistent with my understanding, is that over the long term, like the life of a mortgage, call it 25 years, if you have the cash flow flexibility to deal with the rate hikes that you've mentioned between 200 and 300 basis points or something like that, more often, most of the time, a variable is going to be a better choice. Fair?
I would say more often than not. Now I've
Yeah.
done these back tests myself, and I can tell you that variable rates win much less depending on the assumptions. And some of my back tests, they've won as few as 60% of the time instead of 80 or 90.
Right.
So it really depends. The one thing I'll say is that with a variable, the bank's paying you to take the risk. It's much less expensive for a lender to hedge their rate risk with a variable than a fixed. That's one of the reasons why you pay that premium in a fixed mortgage.
Yeah. It's like insurance, call it insurance. And given I'm in a variable and I've had my head handed to me on a platter recently, but over the course of time, I think I've done pretty well. I want to ask you about where a HELOC fits into your framework here, because as people go to mortgage renewal, some will choose to ensure that they've got that additional safety. As you apply I.D.E.A.S, when do you say that's a good idea? And when is it not a good idea to add a HELOC as a part of that product?
Yeah, so a HELOC gives you liquidity. And so, that can make up for maybe you don't have as much equity available, or maybe you don't have as many liquidatable assets. Is that a word?
Sure.
It is today. A HELOC is critical if times get tough. Let's say you lose an income in your household, and you have no other optimal way to generate cash to pay your bills for a short term until you find a replacement income. HELOCs allow you to have a safety net. And, a lot of HELOCs grow over time. So in terms of the credit limit, so as you pay down that mortgage principal, the lenders allow you to borrow more money from the HELOC. And HELOCs are not meant for people who are not disciplined,
Yeah.
who like to buy sailboats or big screen TVs on a whim. But they can be crucial for folks that have a life event, maybe an unexpected illness, even divorce, or maybe you want to fund a business or
Yeah.
a good investment. They're a very low cost of funds.
Yeah, they can take the pressure off that emergency fund that we talk about. Like, you need to save 6 to 12 months of net income. Like, that is never going to happen. But maybe I could do something similar by providing myself with that insurance with the HELOC. One last question before we go. What is the single biggest pitfall that you see time and time again as people try and assess these two fundamental decisions around and term and variable versus fixed? What's the one thing that if you could snap your fingers, you would alter forever?
Well, a lot of people have preconceived notions of mortgage terms. So, for example, should I go fixed or variable? Well, you can go both. You can go half fixed, half variable, and that's supported by academic research. It's called a hybrid mortgage,
Mm.
and or you instead of going with a traditional floating rate that has a payment that moves up and down with prime, you can get a fixed payment variable. There's some lenders out there like CIBC and BMO, for example, where the payment doesn't move at all. And in many other cases, even with a fixed payment variable, there's a thing called the trigger rate, where if you're not paying all your interest due, the lender's going to increase your payment so that you at least cover that interest. So you really got to know what the rules are and how your payment actually moves or doesn't move if you want to limit your risk.
Really interesting. Rob, thanks for joining us today. We appreciate it.
Always fun.
Rob McLister is founder of mortgagelogic.news, and he joined us today to talk about an acronym he came up with called I.D.E.A.S, I-D-E-A-S.